Hello and welcome to Prism Business Wargames overview of key metrics and ratios for manufacturing and other industries. In the video, we're going to review some common metrics that manufacturing companies and many other types of companies use to gain insights into the effectiveness of their business and the strengths, weaknesses, and improvement opportunities in performance. And if you'd like to take the next step and really bring these numbers alive after you watch the video, contact Prism to find out more about our mini MBA course in business simulation. So to start, a financial ratio relates two numbers to each other, sometimes drawing from more than one financial statement. And the goal is to highlight the relationship between the numbers so that an insight into the business can be generated. And it's important, if you're going to use metrics, that you know what specific numbers are being used in a metric. Someone else might have calculated the metric very differently than you would. They might have included or not included some details. So be careful of differences in calculation or how they're defined. But typically there are common ways that these metrics are calculated or industry standards that exist. And also be wary of comparing ratios across industries where they might make more or less sense. And be careful too about reading too much into a single metric. You really need to understand how that metric compares to the industry or to the past performance of the company and how it's related to the current strategic direction or condition of the company. But overall, there are categories that financial ratios will typically fall into. These might include profitability ratios, liquidity ratios, activity ratios, or solvency ratios, among others. The first metric we'll talk about is gross profit margin. And as you can see on the slide, it's calculated as gross profit divided by net sales. And net sales just means sales net of trade discounts that you might have offered, returns, bulk discounts, things like that. And here's why this metric is important. Gross profit is what's left over after you cover direct materials and direct labor costs, or COGS, which is cost of goods sold. What you paid for an item plus labor costs. So the amount of money that's left over needs to be enough to cover any additional expenses after that, such as overheads, advertising, etc. And if you don't have enough left over, you can run into problems investing in the growth of the business to cover marketing and advertising, etc. As an example of how to interpret this ratio, a gross margin of, say, 20% means that for every dollar of sales, you have 20 cents left over after paying for direct labor and materials. And you need to use that 20 cents to cover advertising, to pay taxes, and hopefully still have something left over, which would then go to profit. And when you see a gross margin number, remember that it doesn't show you volume. So you could have a 20% gross margin, but you still have only sold 2 units, perhaps, just as an example. So you need to really analyze what this number is telling you. And here's another profitability metric, return on sales. And this is an indicator of the overall profit performance of the company. And it's calculated as net profit after taxes divided by revenue. So as an example of interpreting this ratio, if you had an ROS of 7%, you've got 7 cents in net profit after taxes for every dollar of revenue that you've generated. Here's return on assets. This shows us how the assets of the business are generating profit. It's calculated as net profit after taxes divided by total assets. So if you had an ROA of 5%, it would mean that you're generating 5 cents net profit after taxes for every dollar that you have invested in total assets. And remember, the total assets can include cash, accounts receivable, as well as some of the longer term assets that you have, such as plant, property, equipment, things like that. And let's talk about one more profitability ratio, return on equity. And this ratio shows how the capital contributed by shareholders and also capital that is retained in the business is being used to generate profit. This one is pretty important as a metric for publicly traded companies. A lot of investors and analysts look at this metric. And it's calculated as net profit after taxes divided by total equity. So if you had an ROE of 12%, you're generating 12 cents of net profit after taxes for every dollar of total equity that the owners of the company have invested in the business and retained in the business, as opposed to taking out as a distribution or dividend. And here's the liquidity ratio, the current ratio. And liquidity means the ability of the firm to pay for its short-term obligations with short-term assets. And it's calculated as current assets divided by current liabilities. So we're taking two numbers from the balance sheet and comparing them. And current assets includes cash, accounts receivable, and inventory as the big items. And current liabilities includes accounts payable and short-term debt. The number that we sometimes hear as a general benchmark of this metric is 2 to 1, or $2 of current assets for every $1 of current liabilities. And as an example of how you would use this ratio, if you were a supplier to a company, how would you feel about shipping products to them if they had a 2 to 1 current ratio? And how would you feel if their current ratio was 0.75? How would you feel then about shipping them products? Let's talk about an activity ratio, inventory turns. When you're analyzing inventory, you really have two conflicting goals. You don't want too much inventory on hand, but you also don't want too little. So this metric helps you assess that, inventory turns. It's very commonly used by companies that carry inventory. So it's telling you broadly how many times a year your inventory investment is sold through. And as you see on the slide, it's calculated as COGS, which is cost of goods sold, divided by average inventory to account for seasonality that you might have in inventory. So we're taking a number from the income statement, COGS, and a number from the current assets section of the balance sheet, average inventory. And as a benchmark number for inventory turns, it really depends on the industry. One of our clients here at Prism that's in the food manufacturing industry turns its inventory on average 12 times a year. That is about every 30 days. And that number makes sense for them. If they hold their inventory of food products much longer than that, it's going to spoil and have to be thrown away. On the other hand, some of our other clients in the heavy equipment distribution industry turn their inventory of loaders and backhoes and excavators about 3 times a year every 4 months, and that makes sense for them. But regardless of the industry that you're in, if you carry inventory, the ratio is very relevant because inventory can get old and outdated, so you need to sell it off before it becomes a drag on your business. And in addition, you need to make sure you have enough inventory on hand to meet demand. You don't want to stock out of products, which can drive customers away. Here's another activity ratio, asset turnover. And this ratio indicates how you're working the assets of the business to generate sales, and it also gives you a sense for the asset intensity of the business. So as you can see on the screen, it's calculated as net sales divided by total assets. And if you think back to our ROA metric that we had talked about, that was our net income after taxes divided by total assets. So this one, asset turnover, is looking at your assets related or in proportion to your sales level. So if you had an asset turnover ratio of 1.8, for example, it would mean that you're generating $1.8 of sales for every dollar of assets that you've got. Here's a solvency ratio, financial leverage. And solvency means how well the company can meet its long-term obligations and how well it can expand and grow into the future. Leverage just means the relative amount of debt used to finance the firm's assets versus equity or shareholders' investment. Financial leverage, as you see on the screen, is calculated as total assets divided by total equity. And it seems counterintuitive since debt is not actually in the formula. But the ratio will tell us the relative level of total liabilities because it relies on the structure of the balance sheet in which assets equal liabilities plus equity. So if you had a leverage value of 10 that would mean that you have $10 of assets for every $1 of equity, which, using the structure of the balance sheet, means that you've got $9 in liabilities. If you had a leverage of 4, it means that you have $4 of assets to every $1 of equity, and that means you must have $3 of liabilities. That's a quick overview of some key ratios and metrics used at manufacturing companies and many other types of companies. Thanks for watching, and if you'd like to take the next step and really take these numbers to the next level, feel free to contact Prism or visit our website to find out more about our mini MBA course and business simulations. Thanks again.